Well, in other news, the US economy is showing multiple signs of stress across consumption, inflation and financial markets.
Now, real consumer spending has slowed to levels not seen since the 2020 crisis, raising concerns about the strength of America's key growth engine. We'll take a look at our next report to know how American economy is reeling under this new reality.
The US economy is showing clear signs of strain on the demand side, with real personal consumption expenditure rising just 0.8% on a 3-month annualized basis. This is the weakest pace since the 2020 crisis and close to levels seen during the 2001 recession. Given that personal consumption accounts for nearly 68% of US GDP, the slowdown signals a direct risk to overall growth momentum. At the same time, inflationary pressures are building again. In March 2026, US inflation rose to 3.3% year-on-year, up from 2.4% in February. Energy prices were the main driver, surging 10.9% in a single month. This marks the sharpest rise since 2005. Fuel oil prices saw an even steeper jump of 30.7%, marking their biggest increase in over 2 decades. The combined effect of weaker consumption and higher prices is tightening household budgets and weighing on demand-led growth. The ongoing conflict with Iran has emerged as a major economic shock, with direct fiscal and market consequences. Early Pentagon estimates suggest the US spent over $11.3 billion in the first 6 days of the war, rising to around $6.5 billion by day 12. Much of this spending has gone towards advanced weapon systems and operational deployment. The Pentagon is now seeking an additional $200 billion in funding, pushing defense outlays sharply higher. This comes alongside a proposed $1.5 trillion annual military budget, even as non-defense spending faces cuts. Officials have acknowledged uncertainty over the total long-term cost, highlighting growing concerns in Congress over fiscal transparency and rising deficits. Financial markets are reacting to this pressure. The US 10-year Treasury yield has risen from about 3.96% at the start of the conflict to around 4.5%, before stabilizing in the 4.25 to 4.4% range. Higher yields reflect inflation fears and increased government borrowings, both of which are tightening financial conditions across the economy. At the same time, wealth distribution trends show a widening generational divide in US financial assets. Americans aged 70 and above now hold a record 17% equities and mutual fund shares, while those under 40 hold only about 3%, nearly 2000s levels. This gap has widened significantly since 2008 financial crisis. Public sentiment is also weakening. Around 73% of Americans now describe the economy as poor, while approval ratings on economic management have declined.
The cost of everything that we do is going up. And the income for everything that we do is going down. And just availability of stuff is also getting to be a challenge. And then I've got so many friends that I've got, customers who can't afford to shop at this anymore. I've got farmer friends who've gone bankrupt.
Analysts, including Citi, warn that the US economy is shifting away from a stable, Goldilocks environment towards a more inflation-prone and volatile phase, where growth remains but at a higher economic cost. Business Bureau, WION World is One.